two questions related to naked puts, one from Salvatore, one from Stefania, and this is not a negative by any stretch of the imagination. It's just going to take me a moment. They're pretty long questions, so I've got to read each one first in tune, and then Ed has a question as well related to something similar but a little bit different. All right, so let's start off here with Salvatore's question. He says, in selling puts, cash secured or naked put positions, how do you determine the sweet spot for expiration strike price if you want the highest probability of the option expiring worthless? Is that the percent probability above any other indications that will give the probability of expiring worthless? Yes, Salvatore, it's the percent probability above. And Salvatore says, for example, I was looking at ISEE 917 strike at 750. Okay, we'll start there. And Stefania's question related to this is using the sell put out of the money search to evaluate 30 to 45 days options trades versus at the money advantages or disadvantages. We've already kind of covered this for the covered call, and that's good. It relates to Salvatore's question, Stefania. It's a good question, don't get me wrong, but we've sort of the same concepts we just discussed a moment ago for Pierre, with what to look for on a covered call with out of the money versus at the money versus in the money is the exact same thing you look at for a naked put, in my opinion. What are the differences between the two? At the money doesn't have a higher probability as expiring worthless, but you're getting more time value. You maybe put the stock more often. If that's your goal, Stefania, that's fine. Going out of the money means what? Lower premium, lower naked yield, but a higher probability of that expiring worthless and then looking to sell new positions going forward. But we're going to take a look at all of that, starting with Salvatore. How would I do this? Same approach we talked about for Ben. I'm sorry, not for Ben, for Pierre, my apologies. On the covered calls. If I have a stock in mind, I feel the simplest tool to use, Salvatore, is the option chain, just as we saw for the covered calls. Rather than looking at the call chain, though, I'm going to look at just the put chain, where I can customize it for the fields that I want when selling a naked put. That's going to be the percent to break even, similar to the downside protection in a covered call, and the percent naked yield. Of course, also, the percent time value helps as well. And of course, the probability above. Similar factors to what we just talked about with the covered call screen. Which one is the best one? Just as we sort of mentioned for Pierre, that comes down to your goals, what you're looking to do. Now, in general, when I discuss bull put credit spreads, I'm looking to sell a put and buy a put. I'm looking to get the return that I want, which is around 12, 15%, with an 85% probability. Does that necessarily mean, Stefania, that that's what we have to do with the naked puts? No, but I tell you what, based on these prices, you're looking at the 750 strike. Not at the money, it's out of the money. We're going to go with the 10 strike being at the money, the highest time value there at 21.9%. Obviously, highly inflated position, high implied volatility. We can see that right there. Extremely high implied volatility. Very dangerous, Salvatore. Very, very dangerous. These are not the type of positions I open for naked puts, covered calls, standard collars, bull put credit spreads. Something's on the horizon that could cause this stock to shift drastically. Whether it's a phase 3, FDA phase 2 or phase 3 approval, they've got a drug in the pipeline. These types of stocks where you see this volatility, if that event comes out for the trial, if it is in fact a trial, it could just be earnings, but if it is in fact a trial, I've seen stocks that were trading at $11 with a 12 strike call for a covered call position at a $4 premium. How can you lose? Your break even's at 7. Will you lose when that event comes out, the drug fails, and the stock falls to $1? Your break even was 7, the value is now $1. What happens to all the options? This implied volatility essentially goes to nothing. You have a $1 stock, the 250 strike is going to be worth 2 to 3 cents. If it has a $1 strike, it's going to be worth 10 cents. That premium is gone. It's very difficult to manage. Of course, as a naked put position, if you did that, same thing. I sell the 11 strike or 12 strike put for $4. I still have a break even of 8. I sell the 750 here for $1.13. That gives me essentially, if I put the stock, a cost basis of $6.37. But if the stock's at $1 per share, that's still a significant loss. That's a concern. But breaking down what is the best strike price here. The 750 gives a very high premium, very high percent if unchanged, and naked yield. You're looking at 15% naked yield with a 67% probability. Going to the 5, it's only 38 cents, but what are we talking about here? We're talking about an obligation of $5. That's a 7.5% naked yield on this put with an 88% probability. But if there's a phase 2 or phase 3 trial coming up, Salvatore, throw all these numbers out the window. Sorry to say that, but that's the truth. But Ed, I'm sorry, I didn't get to your question yet. I'm still going to cover your question during this discussion, and we'll have it archived. What I may do, Ed, is review your discussion there and then put it together in a different presentation over the weekend so it's a little bit more crisp and clear, Ed. But I'll get that for you, and you'll see the archive, Ed. I'm sorry you have to go. So you need to research and analyze what's going on. Why are these volatilities in the 300%, Salvatore? Don't look for the highest premium. Don't try to trade the highest premium for a covered call or naked put. This is where you get burned. These are the types of stocks that could fall to $1. Hey, it could go into your favor, and this stock could go up to $17 or $18, and you've made a 15 or 7.5% premium. Is it worth the gamble of getting a high premium here of a potential 7.5% return, but seeing the stock drop to $1 if it fails that FDA approval or whatever event is coming up, Salvatore, for the sake of trying to get a higher return than being a consistent return on more quality stocks? That's a question you have to ask yourself, Salvatore, and I can't answer for you. Something really big is going on with this position, with that implied volatility. The higher premiums might not be worth it. These biotech stocks, if it is a phase 2 or phase 3 trial and it fails, can drop to $1. These option premiums say, oh, if I can get $1.13 here, if it falls down to $4, the 5 will be at $1.13. No, it'll be at 3 or 4 cents. The implied volatility after that is going to go to 0. Okay. And then, of course, you had mentioned, Salvatore, the sweet spot and expiration days. You're here. Okay. When selling premium for covered calls, naked puts, bull put credit spreads, bear call credit spreads, even income strategies, you want to be shorter term. Okay. You get the higher annualized return, just as we talked about before in Pierre's question on the covered calls. Okay. So now we have the annualized. I didn't put the annualized up here. We're going to add that in, and we're going to show you that. So really 10, 14 days out in time is what I've found to be the sweet spot for my positions on bull put credit spreads, other credit spreads over the 4 or 5 day out positions, and over 30 days out in time. What's the advantage of going, of course, to October? So we're going to hold that there. September, we're going to go to October. Well, you're going to get a higher premium, but it's not double. You're moving from 14 days to 42 days out in time. That's almost 3 times the amount out in time. It's exactly 3 times the amount in time. Are you getting 3 times the premium? No. You're moving up from a 15% return naked yield to 25.3. Well, the 5 strike is double from 7.5 to 15, but it's triple the time. This is the other aspect of options. We've already talked about the at-the-money bell curve, which does have the highest time value and the highest premium. But we want some better probability of that expiring worthless. But since this is obviously something coming up with volatility, implied volatilities at 3 or 300%, something's coming up in that case, Salvatore. And that's what you have to worry about. The at-the-money bell curve. But the other thing is, of course, is that the option that's 3 times out in time, 6 months out in time, 12 months out in time is not going to be 12 times the premium, 6 times the premium, or 3 times the premium compared to the 1 month or shorter term series. When selling, we want to go month by month if possible, week by week, but we found the sweet spot to be in that sort of 10 to 14, 10 to 15 day period. And of course, as I mentioned, we go to add, remove columns. We're going to add percent naked yield annualized from our list here. There it is, percent naked yield annualized. I'm going to change the column order, put the percent naked yield annualized right next to our naked yield. Let's get that going there. Okay. Now, 750, 14 days out, 67.5% probability, 15% naked yield, 391 annualized. 750 to October, lower probability because there's more time for it to go against you, 25.3 static, 220 annualized. It's looking a little bit better, isn't it? 7.5 with an 88% probability for September on our 5 strike, 15, 77.5 probability, more time for the stock to go against you, and 130 versus 195.5 annualized return. Now, I'm not saying that your target, again, should be 7.5% on a naked put with an 88% probability every 14 days. The only positions that are going to offer that are these extraordinarily risky 200, 300% implied volatility. We show is 2.53%. These are the ones that can quickly fall to $2 per share or $1 per share, and the highest premium you're getting is not helping you with that type of decline. Okay, so what should you look for? And this goes right into Stefania's question. Selling a put out of the money search perimeter to value 35 days out versus at the money, advantages and disadvantages. Well, again, the advantages, you're closer to at the money with the ATM screen on a naked put, so you're probably going to get put stocks more often. Is that your goal, Stefania, to potentially buy more shares of stock to increase your holdings? If you're looking to sell puts because you're trying to generate a good 1 to 1.5% yield every 10 to 20 days, and you want a good probability of them expiring worthless, you want to stay slightly out of the money. I don't mean going 10% out of the money or 20% out of the money. And if you feel that the market could have a correction soon and fall 7, 8, or 10%, don't sell puts that are 8, 9, 10% out of the money. Just don't sell puts. Use a bearish strategy if that's your expectation. I know that's not what you're asking, but it's not worth it. So what is the criteria that I'd look for? Well, in general, I follow what Ernie selected for the picks of the day. You know, his weekly picks of the day going 1 week out in time, minimum percent naked yield of 0.5%, good break even. I might look for a little higher. I'm going to put that to at least for a 1 week out trade to a 1% break even. Probably not going to be the best results. Ernie tested these extensively, but I'm thinking I like a little bit of 1%. It'd be at least 2% out of the money. And we're going to look for some basic stock criteria. I want stock that's in an uptrend. I want to avoid earnings between now and expiration. I want stocks between a good price range and greater than 5% earnings per share growth. Okay, so let me just submit with my change and see what we get. And we still have good positions. Marathon at 43.41, 42 strike at a 3.3% naked yield. I might want to drop down to the 41 strike if that's still within my trading range. But you have some good positions here for 5 days out that are 1%, 2% yields, 1.5% yields. And where's our probability? 64, 65, 63. I'd probably look a little bit higher. But again, what you're asking yourself here, Stefania, is what do you want to look for? Are you looking to be assigned consistently on positions where you're adding to your stock portfolio with the put options that you like? Or are you hoping that the put expires worthless on a consistent basis, say 70, 75, 80% of the time, but you're still making your 1.5% return, 2% return every 14 to 20 days? Okay, you said 30 to 45 days. Fantastic. So let's focus on more of a 2.5% yield. And let's just do something from scratch. I'm going to jump off of the picks of the day here. 30 to 45 days. Well, we're on October right now, of course, Stefania, so we'll just use that as the base point. What am I going to look for? I'm going to look for things that don't have that implied volatility we just saw in ISEE. I'm going to look for implied volatilities of less than 1.4 or 1.2. Now, I want my naked yield. What did I say? We want to be at least 2.4, 2.5% or higher for our 42 days out. I want to be a good percentage out of the money, probably about 3% of the money, but that percent to break even. Similar to the downside protection to be comfortable. Let's go with that. We're looking for a 2.4% yield, but with at least a 3% to break even. If the stock starts declining, it can fall 3% before we hit the break even point. Strike price, not going to worry about. Bid-ask spread, yeah, let's limit that to 50%. But let's look for a good probability. Let's start at 75. I want to find positions that have a 75% probability of expiring worthless, because that's the goal I want here, if that's the goal. Okay, we're going to take a change in a moment. Now, I want to see something with some volume today and open interest. What about the type of stocks? I'm going to use very similar basic criteria to what Ernie was looking for, what I went for in a cash secured naked put, where if the put expires worthless, stock stays above my strike, the put expires worthless, we keep the premium. And here we're looking out of the money for a good probability. Or if the stock's put to me, I want a stock with good underlying fundamentals. But we use some of the same things, Stefania, we just saw in that other search. I'm going to look for a good average stock volume. This one's measured in thousands. You can hover over the filter to see what you want there as well. But we're going to look for at least a volume on the stock of 750,000 shares on average per day. I am going to look as well for stocks trading above the 20-day or maybe the 50-day moving average. I want it to be in an uptrend. I want to keep it simple, though. Good volume, in an uptrend, fundamentals. I don't know your account size, Stefania. I don't have to. But as we saw before, I'm probably looking for stocks that are under a certain price range because I have to realize the outcome of the naked put position is that I may own shares of stock. I may be assigned shares of stock. So I'm going to keep it within my level, what I'm allocating to this position. EPS growth greater than 5%. What does that mean? I want to see stocks that have had an earnings per share growth of at least 5% or more, a reflection of good management in the company. Now, I'm going to avoid earnings between now and expiration. What doesn't this do? This doesn't avoid stocks that might have that FDA approval coming up. Now, I could go into the lists and choose to remove biotech, security, sector or industry, Stefania, excuse me. I could do that as well. But let's just run the search and see what we get. Not surprising, marathon, but look, we can go deeper out of the money here to the 33 strike or the 32 strike. This does have a relatively high implied volatility over 1.13. That's why the premiums are enriched. Let me make a change here so it's easier for us to see. We're going to take one result per security, and I'm actually going to sort it by percent break even, showing me a better safety than what we're looking at as well. Okay? All right. So there we go. There's the marathon. She's deep out of the money. The returns are all mixed now because I'm sorting by more or less the probability as well as the percent to break even in this case. But there's, oh, Nicola, I probably wouldn't touch. Sorry, that one came in there again. But this is just a general rule of thumb. I might decrease this a little bit more. I don't like what I'm seeing on some of these. Let me just take a look. Yeah, that's okay. We're going to cut this in half, actually. We're just going to do this for the sample here to show the better results. I might have used the market cap as well to do that. But there we go. Silvergate, CC, Cornstalk, Asana, Digital Turbine is in there. I figured as much. That would show up. Lunar Technologies and so forth. All right, let me save this very quickly. And we're going to save this as OTM, naked put, basic filters. I can't tell you what the results are for these. We're looking for reasonable probability. As I mentioned with my bull put spreads, I look for usually about an 80 to 85% probability with the return I want. Okay. All right. Now, that being said, I'm going to make one subtle change. We're going to go no more than one strike out of the money. Still looking for a percent to break even of 3%, but a probability of, say, between 45 and 55. To do what? To keep the same basic criteria, but now go right at the money. Cerevel Therapeutics, 35.19, selling the 35 strikes. Silvergate, 120. Comstock Resources, 7 and 7. So you're right at the money with the screen. The returns, double, triple to what we saw on the out of the money screen. Probabilities, 50%, 52%, exactly what we look for. Let's save this now. This is the at the money. Naked put, very basic filters. This is not a recommendation to use these filters for your screen. I prefer to see you use the tested ones that Ernie's done with the picks of the day for the monthly and for the weekly. Why am I going through all this? All right, let's take a quick look. We're going to go in a back test. 1 or 2 cycles does not the market make. However, let's see what would have happened on the webinar account, on the test account, trial account, excuse me. You can only go back a few months. So we're going to go back to July 19th, Monday following the 16th, the expiration date. And we are going to use our out of the money naked put basic filters. We're going to see what results came up, and then we're going to calculate the group. Oh, 1. Okay, so July, that gives us 1 to August. How did we do? I'm going to hit calculate group results. Okay, we made a 2.4% return with 100% success rate. And of course, now I could go back. I know we're not there yet, but I could go back to August. And we're going to go to that expiration, the 23rd, run this. And so our August to September. I know we're nowhere near September expiration, but we want to look at 30 to 40 days, Stefania. So here we go. We're going to run that screen. It takes a while now because we're uploading all the history into the database right now. So when we interact with the historical tools during the Friday webinars, this is what we expect. So I apologize for that. But yeah, it did have a maximum. Let's check something real quick if it can come up. Ah, there we go. All right, so we'll worry about that later. Oh, we had 2, Tupperware and Devon Energy. And we ran it on the 23rd because that was the Monday following the standard August expiration. A 2.5% yield and a 2.5% potential yield. These were the out of the monies, remember. Okay, and right about now, both are at a 1.8%. Okay, let's see here. So both at, we're not near the max profit yet, but they're both at 1.8, 1.9, pretty close to, well, not quite 50%, but close to it. Oh, yeah, I'm sorry, above 50% of the expected return in the first 10 days or so. Okay, yes, so Stefania said, if you're on the trial, you have this 2 or 3 months of back testing available to you on a trial, Stefania. But if you subscribe and want to use the back testing, you'd have to subscribe to the historical level of service, which is $100 per month. Okay, so we've got what we have there. Let's call it a 1.85 average return for the 2 cycles. I'm sorry, let's go back. And I want to go to July 19th, Monday following the standard expiration, alphabetical order, at the money. Let's see what we get here. Okay, so we have more results. We have 11 results for the at the money. Okay, so the ATM, we're going to get a mixed bag here. We expect that when you have more results. Not saying you trade all 11, Stefania, but if you did, trade all 11. That's taking a longer time to do. So that was the OTM and the at the money. Now, remember my disclaimer. 2 market cycles does not the market make. All right, so 100% success rate, naked puts using that basic criteria at 2.2% return. Remember, that's interesting, isn't it? So not all of these were full profit. Okay, you made a profit here. We sold the Fox A37 at the money put, but it fell to 36.89, so we had to buy it back. Original expected yield was 2.9, so a 0.9% return. You had to buy it back if you didn't take assignment. Same here. Anything you don't see at the maximum return. Cheniere was small buyback cost. Lincoln National expected 3.4% return, but it's only a 1.1 after the buyback. Okay, so not all of these reached full profit. In fact, it doesn't look honestly like any of them did. They're all slightly little buyback cost at the money. So you had 11 out of 11, but it was a 2.2% average return. The out of the money in this cycle was the 2.4. You didn't have to buy anything back. There's only one trade. All right, let's go to the next cycle, see where we stand. August, 30 days out. Next cycle, 23. Submit. 11 out of 11, similar stocks that match the criteria during this time frame. And we're just going to let that load for a second, and I'm going to do something else while we're waiting for that. Here. All right, there we go. Okay, I know you're not seeing it. Don't worry about it. All right, there we go. Not too bad. Was this the right one? August 23rd to September expiration. Yeah, we're not there yet. We haven't hit expiration yet, we're looking about the same thing. We still have a long way to go. 25 days initially to go. We've only gone through about 6 or 7 days here. But this is almost the same, a 2.2% return on these positions that we found in August 23rd to September expiration, and here's where we are right now. None of them are near the full profits. Similar stock names because of the criteria that we used. Versus, remember, the out of the money in this case was 2.5%. It's only two positions. I'm sorry, my apologies, 1.85%. That was the average of those two positions. It was a 1.58% return. So it comes out even in these 2-month cycles, Stefania. But again, we're not near the full expiration for September. 1 or 2 cycles does not the market make. But what I can tell you from just that basic test is that it performed better in the August, even though you had 11 positions versus 1 or 2 positions, where we had a 2.4% return July to August with the out of the money and a 2.2% return taking into account all the buyback costs in those cases. All right. And then, of course, the September ones right now are showing an average of a 2.2% return with a 100% success rate if liquidated, and the out of the money was only 1.85. But I want to go back to this concept of just the naked put search in itself and what I mentioned about the monthly and weekly picks of the day. You already saw the weeklies. On the monthlies, Ernie's going 6% out of the money. And the probability is 63, 65, 17, a little bit out of the money here. Good range out of the money there. Good range out of the money there, so on and so forth. This is based on Ernie's testing, where he took various stock fundamental and technicals and various option criteria for the naked put strategy and the covered call strategy. Essentially 80 different iterations of combinations for each strategy. 80 essentially, or 50 to 80 essentially for monthly naked puts, and 50 to 80 for weekly naked puts. Looking at the money, looking at out of the money, removing earnings between now and expiration, not between removing now and expiration, doing different technicals, Bollinger Bands, MACD, and other things. So what is this monthly picks of the day? This is the criteria that over the testing cycle, Ernie found performed best. Best success rate and best overall return. Success rate means winning trades out of losing, not using, not allowing the stock to be assigned, just closing it for the in the money value or intrinsic value at expiration if the stock fell below the put strike price. That's why these are here. And if Ernie had seen that a closer to at the money monthly or weekly naked put in that testing time period outperformed the out of the money, going 6% out of the money here and that 2 or 3% out of the money that we saw for the weekly naked puts, he would have had that. This is why the out of the money ones are here, because his testing showed, just as our testing, 2 cycles does not the market make, I understand that, in that case, that the out of the money one, although we had similar success rates, had a higher return without having to factor in the buyback costs on those put options where the stocks fell just slightly below the put and you didn't receive the maximum return in that case. So I think it's better to go out of the money for long-term consistency, but still hitting a return target that you want for a monthly or weekly naked put. Okay? And Salvatore, you had mentioned if the valuation technicals and fundamentals are favorable, then perhaps you wouldn't mind owning the stock even if it takes a big hit. Well, this is where I started the conversation. I don't know Stefania's trading plan, and we're not going to address that here. If the goal is, again, to potentially put those positions that Stefania feels meets the technicals and fundamentals as you mentioned. And one thing I always say, and someone had a YouTube comment that mocked me for saying it was a stupid comment, but I commented that usually in these webinars that you should never sell a cash secured put, naked put on a stock you would not mind owning. That's why I put those technicals in. It's the same type of technicals and fundamentals I'd look for if I was doing a covered call, a collar, or potentially a married put position in those cases. Okay? Because I don't want to look for the highest premium. No offense, Salvatore. I don't want to look for the highest premium. I don't want to risk trading something with a 100%, 200% implied volatility that has a phase 2 or phase 3 drug trial coming up and can drop from $8 to $1 per share 2 mornings from now as soon as I wake up. Stop orders are gone. Any kind of stop you put in your broker, absolutely gone. You get filled at the worst possible price. You've now got a stock trading at $1, but there's no option premium because the event has passed. Repairing it is essentially impossible. There's no premium, even though they still offer options, which they might not offer options anymore. In the next 3 to 4 months, the stock falls to that price. So the goal is to get constant premium in returns, Stefania. I think personally, I would say slightly out of the money, good probability, 70% or higher, maybe even a little bit further out of the money in this, looking for quality stocks that, as we just mentioned, have the same fundamentals that you would use to buy a stock, because that is a potential outcome on the position. All right, I'm not sure if Ed left or not in that case. So we'll probably lump those two together. I apologize for Salvatore and Stefania with that naked put discussion.